Welcome to Two Boomer Women. I'm your host, Agnes Knowles. I've been talking with Boomer women for almost a decade now. Well, I guess I've been talking to Boomer women all my adult life. Reinventing myself several times along the way, though, but always focused on us, Boomer women. With this incarnation of Two Boomer Women, I'll be interviewing other women who have a message of interest for our demographic. If you want to hear about or learn about something specific, let me know and I'll find someone who understands us to talk about it. There's a contact page at twoboomerwomen.com. If you want to be a guest on Two Boomer Women, bring it on. There's an application form at the website too. Finally, this show is all about conversation. We women know its value. We know how to do it, and we must perpetuate the art form. So let's get started with today's show. Welcome to the Two Boomer Women podcast. I'm your host, Agnes Knowles. As we try to return to some sort of normal as the pandemic slides off the radar, we're being hit with a global financial predicament. This predicament has all the powers that be searching their thesauruses, or is it that thesauri, for a word that isn't recession. So it was timely that my guest today reached out and introduced himself. He calls himself the prolific investor who challenges conventional wisdom. He wrote a book called Get Off Your $, I like that. Get off your ass and manage your money. Now, I've written several articles over the last few years about how retirees' income levels often do not cover the basics of daily life. Government pensions are sadly inadequate at paying the bills, and there are many people who don't have other work pensions to draw on, who made ends meet over their working years but are now struggling with reduced income and increased costs, or those people who were full-time homemakers so don't collect CPP. And that's the kind of pension plan for those of you who are other than Canadian. All workers pay into the fund over their working years, and then the government pays out a pension post-retirement. Chris is American, so will no doubt mention 401ks, maybe taxation. Do a bit of research in your home country and see what you can do to match his suggestions where you live. Chris Odegard, welcome to the Two Boomer Women podcast.
Hi, Agnes, thanks for having me on here. I hope I am a man, so if there's two women, it's just you and me, right? Formerly two women. Well,
it's funny because I went through a stage where it was Manly Monday, and then I had a really hard time finding a man for regular Mondays. And then a lovely young man who was on podcast said, you should call it Monthly Man Day. So I tried that for a while, but men are few and far between. So it appears. I don't know. That's just my experience. So,
well, I didn't see a whole lot of men on your podcast. I went, oh my God, I wonder if she thought I was Christine, a female. Now maybe I'm not even supposed to be here.
No. You're welcome, and I'm really pleased to have you. Yeah, if you scroll down there have been men, and for a while I was getting one a month, but we'll see how it goes. But Chris, I want to preface our chat today by saying you're giving us information that we'll digest however we see fit, that you aren't making personalized investment advice.
Thank you. One of us had to say that, so that's good.
Okay, let's clear the air right at the beginning. And is it fair to say your considerations are available in many countries, not just the U.S.?
Yeah, the principles are, I think, universal. Obviously, some of the tools, the different retirement plans vary country by country, but the principles are pretty universal. So
yeah, okay, that's great. I checked out your website, and it seems that you were a conventional investor using conventional wisdom for a number of years. Right. Could you start by explaining conventional investing, please?
Sure. Well, in the investing world, there are conventional investments and alternatives. That's the big dividing line. And it's really easy everything that is a conventional investment is something that's publicly traded. So it's traded on on a New York Stock Exchange or the Canadian Exchange or whatever. And then everything that's not publicly traded, those are alternatives. And that would include, every type of real estate, commodities, gold and silver, notes, private shares of small businesses, So everything that's not typically publicly traded, those are alternatives. Private lending, cash value life insurance is actually a really good, which I should preface that, say the properly constructed cash value life insurance is a really great alternative investment. So yeah, everything that's not on the stock market. And so I say that I was on the 401k highway to mediocrity for many, many years, and then some things happened to me and I changed my ways. But I have a really interesting statistic in that, for those people who are using some type of retirement vehicle like a 401k or its equivalent as their primary retirement tool, 92% of those people will not get there. They will either have to work longer or they will just have to have a reduced retirement lifestyle, because those, the whole philosophy behind those plans is to build this giant mountain of money. And when you use something called the 4% rule to figure out how big that mountain of money is, just to have a normal standard of living, it has to be a multi-million-dollar portfolio, and only 8% of the population ever becomes millionaires. So then there's the 92% of us, right? And we thought we were going to, build this giant nest egg, and for 92% of people, they're just not going to get there.
Well, I must say, I liked some of your blog posts, because when I write my soapbox pieces, I use real numbers and I crunch those numbers, and I was reading real numbers on some of your blog posts. So it was like, yes.
Well, it's one of the kind of things, it's one of the things I like about what I do is that I can actually pull out the math and demonstrate that what I'm talking about, you have to make some assumptions because everybody's situation is a little bit different. But with these set of assumptions, here's the answer. And it's not a good answer, right? Yeah.
Well, what started me onto my little working my way up onto that soapbox was the fact that I was meeting women who were retiring, and they just thought that pensions would cover their lifestyle. Mm-hmm. And they were selling vehicles. I know somebody that actually had to sell their house. And I thought, like, holy crap, like there's obviously a disconnect somewhere. So that's what started me on my ranting and raving. Okay, so you were conventional, and then somewhere in your mid-40s, your financial stability went sideways. How did you start your journey to where you are now?
Well, somebody said I should read a book, and there are millions of people who can tell the same story that they were handed or told about Robert Kiyosaki's Rich Dad, Poor Dad book, and I read that book, and it was like a lightning bolt. The clouds parted, however you want to say it, and I was like, oh my gosh, there's this whole other world out there that I didn't know anything about. Alternative investments and mainly real estate is what Robert does, and so I started going down that path. And my big what I call moment was I got divorced in my mid 40s and lost 55% of my assets and thousands of dollars a month in cash flow. And so that was the motivation that, things were kind of mediocre before that. And, these things happen to men and women, or it could be bankruptcy, or it could be a health issue. And all of a sudden, your life savings is kind of devastated. So that was the motivation. And I started off the same way a lot of people do, single family rentals and, a duplex and a fourplex. And then today I primarily invest in limited partnerships and syndications in apartment buildings, where I'm just completely a passive investor. And just so, over the history of the stock market, of the S&P 500, the big U.S. index, the average return to investors has been 9-something%, just a little bit shy of 10%. Well, in today's environment, that's before taxes and inflation. You're not even maintaining your buying power, so you're actually losing money. And in my world, it's not uncommon to make 20 to 30% annual returns, and that doesn't take into consideration the tax advantages that come with depreciation, and the fact that it doesn't have to be your money. The nice thing about real estate is banks and people love real estate. They'll just loan you money to buy it. Nobody will loan you money to build up your 401k portfolio. So anyway, I went down that direction after reading Rich Dad, Poor Dad, and lo and behold, 9 years later, I had recouped all that 55% and multiplied it many times over, and I quit my corporate job in 2018, and I never have to work again unless I want to. And so that would have never happened if I had stayed on what I call the 401k highway to mediocrity. All I did was change the type of assets that I invest in. I was able to use leverage. I was able to get better returns and paid less taxes. In fact, I think it was 2018. I wrote an article about it. It was the same year that President Trump paid $750 in taxes and got a lot of crap for it. I paid zero in that same year.
Okay, you may be my new role model. No. Okay, so you've been teasing us here with a few, ideas. Can you explain a few of the alternate investments and exactly what they are? Like, just go a little wider.
Yeah. So, a single family rental. So you go out and, instead of just having one house for yourself, you're more generous and you buy a house that somebody else can live in. And, the rent that you get pays for all the expenses and puts a little bit in your pocket. And so then you just go from there. You can go, bigger and more and things like that. Another alternative investment that I invest in through kind of a syndication or a fund model is ATM machines. So I'm the owner of ATM machines all over the country, and they provide me a fixed monthly amount for 7 years. And then they're kind of like a used car. You buy it, you drive it off the lot and it depreciates. So at the end of the 7 years, your machine's outdated. It's not worth anything. But you get a really great return on that money for 7 years. So that's another thing.
Okay. I just want to explore the ATM for a second. So you own the ATM. But it's got to be a bank that puts the money in there. Presumably, I don't think you're stocking it up yourself.
So there's just kind of like a single family rental. There's there's ways you could be what I call the DIY, the do-it-yourselfer. You go out, you get a realtor, you find the single family rental, you buy it, you get the loan, you do the tenant screening, the property management and repairs, and all that. And then on the other extreme is something called a syndication, where you have there's a general partner and a limited partner. And the general partner or partners are the people that actually are experts, let's say buying and repositioning apartment buildings and, making them better, improving rents. And I just come along with 100 other people. And we come up with the $20 million maybe to buy this $100 million apartment building. And that's the end of my involvement, except in 3 or 4 years, it comes back with twice as many friends, right? So same way with the ATM machine. I mean, you could have your pickup truck and put an ATM machine in the back of it and drive it to a 7-Eleven, try to negotiate, a 3-by-3 foot lease of land where you could put it and you would, maintain it and put cash in it, or you do it through some type of a similar thing, like a syndication or a fund model, where all I do is buy the machines and somebody else. There are contractors that manage everything else, and I've never seen one of them, frankly. I mean, I wouldn't even know it if I passed it on the street. I have a list of what states they're in, but that's the way I like to do it. I like to be a very passive investor, and my goal is to make the most amount of money with the least amount of my time. So I search out investments that are like that.
I'm just going to go down the real estate path for a moment. In my city where I live, in order to buy a modest single family dwelling at this point in time, I need approximately $1.2 million. So my drawing on the principle of something I already own, because the banks, especially at my age, isn't going to give me 100% financing.
Well, I would say so. The one of the misconceptions is that we have to invest in your backyard. And so a year ago, I moved from Seattle, Washington area down to Somerville, South Carolina. And Seattle has never been a good cash flowing real estate market. So you need to invest where you live is not the place you want to invest. So a lot of Canadian, matter of fact, the syndicator that I use for apartment buildings is based out of Vancouver. Guess where they're investing? In the United States, in cities like Phoenix and Dallas and Houston and Atlanta. So there are what's called, you could invest with somebody that does that, same way that I do. There are turnkey single family rental providers in the United States. And they're kind of like the syndicators, but they're experts in the single family. So they'll go out and buy up these single family rentals and do durable repairs for them because they know they're going to be in the hands of renters. And then they'll go screen and put good tenants in there. And they have a property management company too. And then you just show up with your cash or your bank loan. And, you can buy a single family rental in the United States for $150,000, depending on the market. And then you only need 20 or 30% of that. So you and another boomer woman could come up with the down payment if you needed to, right?
I want them out for a month every year, so I have a holiday home too. No. Okay, let's actually talk dollars and cents. If somebody's coming in with, I don't know, is 10 grand reasonable, or does it have to be 100 grand or whatever?
So if you wanted to do, I'm just going to pull up my last. I did an article. It was one of the more recent ones on my blog, where I compared the three ways of. What was the last one? 46, 3 ways to invest in real estate, which was do it yourself, using a turnkey provider, or doing a syndication. And the minimum investment on that was you could do either one, all of these three for $50,000.
Okay.
So for $50,000, you could get in, and you could get into a single family rental for less than 50 in some markets. And there are some syndicators that'll take as little as 25, but 50 is kind of more of the main, the mainstream for a minimum type of investment in a syndication. But yeah, for $50,000, you could, do it yourself, find a turnkey single family rental provider or an apartment syndicator, for example.
Now, on a more conventional buying proposition, I obviously can't go to the bank and say, please, may I have this much of a mortgage? And here's my down payment, which just happens to have come out of my line of credit. To get into some of these, do you have to have the cash up front, or is that a debt that you could take on because it's going to?
Yeah, no, you're going to have to have some amount of a down payment. And you can't, and the banks are not going to borrow the down payment because no bank wants to do 100% financing for the most part. So somehow you're going to have to come up with that 20 to 30%. There are some loans in there, I think, that are less, but I don't know that you could get that on a rental property. You could get I know that, I bought a house one time in the U.S. on a federal program where it was 3.5%. I think I bought a $300,000 house and I brought a $9,000 check to the closing table. So, but that typically won't happen, with a rental. So.
Now, what sort of debt is it safe to go into? At what point in time is it okay to take on debt?
Yeah, well, here's something that baby boomers are probably stuck with, that they think debt is bad and you should own your house free and clear. The truth is you really can't get wealthy without debt, because we only have, let's say that somebody makes $100,000 a year and their expenses are $95,000 a year. That means there's only $5,000 left to invest every year. So you're really not going to get very far just using your $5,000. That's where real estate is awesome, because a bank you have a good rental property and you can come up with some of the down payment. The bank will loan you 70 or 80% of the money, right? But long term, and in the U.S. we have something everybody doesn't have, but long-term fixed rate debt is the best. Even in today's market where I think interest rates are now up around 5%. From 2.5 or 3. When I bought my first house in the late 80s, I think it was 12%. So interest rates are still relatively low, looking at them over a long, long period of time. But yeah, anytime you can get, that is just the houses in the U.S. at least is the best, the lowest rate and longest term. It's the way to go. So that's why, I never want to pay off a house, right? Because if I have $1 million house and it goes up by 10%, okay, that means the house went up $100,000. It went up $100,000 whether I owned it free and clear without debt or whether I had an $800,000 mortgage. So the money, your home equity is the equivalent of putting cash into your mattress. You would never do that, right? But people pay off their home all the time. And my caveat would be, if it helps you sleep at night and it gives you peace of mind, that's okay. But it's not a good financial move to pay off your house, because that $800,000 of equity is just making the loan more secure for the bank. And you would be better off taking that money and investing it somewhere and making 20 to 30% average annual returns with an alternative investment, because you wouldn't get that in the stock market.
Right. And I'll just add a little personal comment here too, that I was recently cleaning out a bookcase and I came across, those books that we used to see, little paperback things of interest rates and, what you would pay on your mortgage, et cetera, et cetera, et cetera. And I thought, oh, well, I'll give this to my daughter and her husband because they're in the market right at the moment. And then I opened it up and the very basic mortgage rate, I think, was like 10.5%. And I went, not of any use today because they're so much lower now. So, just like things change and that sort of thing. On your website, you mentioned insurability, and that's something I had certainly never thought about. Can you explain that, please?
Yeah. So I created something called the hierarchy of investors, which is a pyramid, which is a bad, a pyramid or a higher, it's a big triangle. And, in the shadow of the pyramid where it's dark and damp are all the conventional investments. And then you get on the pyramid and now you're climbing this ladder. And I compared conventional investments to alternatives across 13 different categories. And the only place where most conventional investments have an advantage is they're liquid. In other words, you can buy and sell them in an instant. That's a stock. You can't buy or sell a piece of real estate at the push of a button. But so some of the advantages we've talked about. The returns are much better in alternatives, and banks will loan you money to buy alternatives. And you can insure your alternative against loss. If you had a house, you would never think, let's say you had a house that was worth $1 million. Most people would never think of not insuring their house, against some kind of a disaster. But some people have $1 million in their retirement plan, and it's completely subject to the market or the whims of a politician or somebody who wants to start a war, and has nothing to do with the fundamentals of your investment. But the value goes up and down like this, and you can't insure against that. But you can do that with alternative investments. Now, alternative investments don't have that volatility because they're just not affected that way because they can't be bought and sold, but you can protect them against loss, fires and thefts and things like that. That was the insurability piece. If you walked into your insurance agent and said, I have this $1 million retirement portfolio, I'd like to buy a policy, they'd fall on the floor laughing. Same thing if you said you wanted to build your $1 million portfolio and you had $200,000 and you wanted to borrow the other 800, they just won't do it. And it's interesting because bankers, insurance people are pretty smart people, but there's something that they don't like about conventional investments. They won't insure them and they won't loan against them. So.
Oh, it's a big subject. Okay. Now, many of us have financial advisors. Are the alternatives anything that they can look at, or is that totally out of their bailiwick?
For the most part, the answer is no. And I have a friend who's he likes alternatives, so he comes and talks to me, but he's a conventional financial planner. And I asked him, and I think this is in the book, I said, so why is it that the conventional advisor or planner won't give you advice on alternatives? He said two reasons. He said, one is because with the conventional investments, it's easy, repeatable money. It's just, they get something called assets under management fee. So if they're managing your conventional investment portfolio and there's $1 million there and their asset under management fee is 3%. Well, I think that's $30,000. Yeah. They're going to get $30,000. And if your portfolio goes up, they get more. But if it goes down, they still get paid. So you're the investor. You're taking all the risk, and they're getting paid regardless. When you make money, they make money. When you lose money, they make money. And then anyway, back to your question, the other reason that they don't do it is because a financial advisor is never going to get sued for recommending a company stock to you that goes bankrupt. But if the stuff that I do in an alternative world are private investments. So if they say, hey, you should go invest in this ATM thing like Chris did, and that turns out to be a Ponzi scam or it goes bankrupt, they could be sued. And so, there are some that do it, but there's so few. I think I've maybe come across one or two, but those are the two reasons.
Okay. This is maybe more information than our listeners need. But personally, I have a financial advisor because both big picture and small picture investments seem to elude my brain and the understanding. Now, I've gotten better with my current financial advisor because she's really patient. But what sort of investment would you suggest a brain like mine start so that I'm confident in my choices?
You mean in the alternative world?
Yeah.
Yeah. Well, the alternative investment world is there's just so many things, and that's kind of one of the problematic things with this, because I can't just say, oh, well, there's this Vanguard Target Retirement Fund. That would be good and easy for you because that doesn't exist. So, I mean, do you like real estate? Do you want to be involved in rentals? Do you like ATMs or even being a private lender? It really depends on the person and their risk tolerance and kind of what their skill set is. And all I can tell you is that I just love having somebody else do, what I do is find somebody else who's good at something, whether it's ATM machines or apartment buildings or self-storage. And then I'm pretty much investing in that team, because you could have two identical apartment buildings, one on either side of the same road, and one operator would just make that thing super profitable and the other would drive it into the ground. So it's not really the asset, it's the management team that you're investing in. So and so that's what I like to do. And I just find good operators and put my money, alongside theirs. And but like I said, these are private investments. It's probably more easy. It would be easier for you to get taken advantage of or be involved in some fraudulent thing than it is in the stock market. So it takes education. You got to do more homework. But the nice thing is you can meet these people. You're never going to meet the CEO of Coca-Cola before you invest, right? But these people, you can go meet them, you can talk to them, and make some judgments about their character and things like that.
I actually have an in with Coca-Cola, but we won't go there. So maybe talk to us for a second, because it sounds, and I certainly understand that educating yourself or finding something that you would enjoy learning about is a really good place to start. But just talk a little bit more about, you call them syndications?
Yeah. So if you're driving down the street in any city and you see this giant, I just keep using apartment buildings because everybody knows what those are, and that's what I like, and you see this 200-unit apartment building, it's very unlikely that one person, came in with the money to build that or buy it, or even one person came in with a down payment and got the bank loan. So say it's a $200 million building. So somebody who's an expert in acquiring and manage these apartment buildings, that would be the general partner, said, let's go buy this one. And they said, okay, so it's $100 million. We need 20 for the down payment and another 5 million to do the repairs. So that's 25. Now they go out and at $50,000 or $100,000 at a time, bring in investors, and those investors, put up that $25 million, and then we share the profits, usually 60-40 or 70-30, with the larger portion going to the limited partners and the smaller portion going to the general partners. And it's just that's the way a lot of big projects are done. Investors bring the investors and bankers bring the money to the table, and then you have the team who's the expert in whatever that asset is, self-storage, shopping center, things like that.
I think what I'm appreciating most about our conversation today is just the fact that some of these things have crossed my path in years gone by. But because I didn't know anything about them, it's like, oh, good, buying an apartment block, that sort of thing. But it sounds like for a certain group of people out there, this is mainstream investing.
Yeah, it is. And it became, and I have to do a little bit of homework on this. So there was a time when this was just, wasn't really available to, people like you and me. I'll just call us average people, not to be insulting, but, and then something.
I'm going to put my bottom lip out now.
Slightly above average. And then with the job in the United States, with the Jobs Act in 2012, something changed, and this became, available to more mainstream investors. But it's still but it's still only a fraction of people that are outside the stock market. So even though it's now it's more readily available than it ever was, it's still only a minority of people that invest this way. And like I said, even though out of the 13 categories where I did the comparison of conventional investments and alternatives, conventionals are only better in one of those 13 categories. So it's just, it's like the first time somebody said the world was round, when everybody knew up until that point in history that it was flat, and one person said, no, I'm sorry, everybody else is wrong and I'm right. So that's me being the first person to say, your 401k, your RRSP, they all suck. Nobody's ever, you probably you're the people you worked with, the family you grew up with, the friends you socialized with, they all put their money in the stock market. And some of it was through these retirement vehicles. And so when you're the person that comes along and said, everything you've ever known is wrong, most people are not going to believe you.
I hope my acquaintance who's a flat earther isn't listening right now.
There you go.
Okay, I do want to say that I'm a legend in my own mind, just to go back to that average person.
Yeah, no, I am too. I say it all the
time. Okay, our audience is boomer women. Mm-hmm. What other things can you say to boomer women about alternate investing? Other than be brave.
Yeah, well, it's never too late to get started. I'm on the, I was born in 1962, so I'm on the very edge of the boomer category, and I got started in my mid 40s, so it's never too late to learn something new and do the best. The one thing is it's people like to beat themselves up. I've said too bad I didn't know this 20 or 30 years ago, but we all learn what we learn based on the environment we're in and the people that come across our path. So it's never too late to get started, and there's lots of things you can do to improve your situation. I mean, if you're sitting on a house with a whole bunch of home equity, get a home equity line of credit, and very carefully and judiciously find a good place to put that money to use instead of letting it benefit the bank by making their loan more secure, right? So get started, and my book is one place where they can get started, just to see all the advantages. And I have lots of resources on my website of the podcasts and books and different places where I've invested my money. So I'm pretty open about all that stuff.
Now, if I go to my financial advisor and say, I want $50,000 out of my investments because I'm going to go invest in a real estate property, something like that. Right. And she's going to say, what are you doing?
Exactly.
So what's my response? Like, how do I be firm?
Well, I think you'd have to get a little bit educated first, because you'd have to know, but here, the advantages of this real estate is that I can use other people's money. I can use leverage. I'm going to get way higher returns. It has a built-in tax advantage. It doesn't suffer the same volatility as the stock market. And complete strangers are going to buy this house for me over the next 30 years. And I wrote an article on this one too. The big selling points of the retirement plans are that you get tax benefits because you defer your taxes till later. That's one. And the other thing is sometimes the company makes a matching contribution, at least here in the United States. And those are the two big selling points. People go, oh, it's free money, so it's a no-brainer. Well, the truth is, if you took the same amount of money, let's say over the course of a year, you were going to put $30,000 into a 401k here in the United States. And so you get a certain tax advantage from that with the taxes that you would save on this one, we'll just call it a one-time contribution, even though it took place, paycheck by paycheck over 12 months. So the value of the taxes and the value of the company match would be, let's just say it was $3. Now, if you went out and bought a single-family rental and you used the $30,000 as a down payment to get a $100,000 property, with the 401k, you put in $30,000, you get $30,000 worth of stuff. with a single family rental, you put $30,000 down and you get $100,000 worth of stuff. You also get built-in tax advantages through depreciation, and you also get the equivalent of a company match. It's called a tenant, complete stranger, paying your mortgage for the next 30 years. So the tax advantages and the kind of equivalent of the employer match in the single family rental was worth $3. It was worth $1 with the 401k. It's worth 3 times as much in a single family rental. And I did the math on my site. So it's not a no-brainer, anyway. But those are some of the arguments, and your financial planner most likely won't believe it because nobody's ever sat down and did the math, right? And so take my article, take one of my articles and say, here's why, because Chris, the prolific investor, said so.
Well, and 2 thoughts come to mind is, first of all, I have had financial advisors on the show, and they always say, you don't have to take what the bank gives you for a person. You can find someone you can talk to, discuss with. So that's my first thought. And then about those company match things in 2007, when so many investments were going down the tubes, I literally wouldn't open my statements. I'd just say, it's only the company's money I'm losing. It's only the company's money I'm losing. Right. So, all those stresses that probably don't happen. And I'm just going to throw this word out there in terms of recession proof. For the most part, are these recession proof or?
Well, so I started I think I've made my first ATM investment in 2016 or 2018. Anyway, years before COVID came. And the way that works is, I put in a certain amount of money and I just get a monthly. So as a group, we buy all these ATM machines, and the operator knows that, look, if I run these things right, if I had 7 ATM machines, each one of them would produce a different amount of money because it would be located at a different place, and each one of them would have different transactions. The way we as the owners, we get a percentage of those, $3 or $4 fees every time you take money out of your ATM. What they've done is they've done the big math, and they said, okay, if we run these right, we're going to average this all out, and we can give everybody $2,000 a month. It's exactly for $100,000 investments, it's $2,155 a month. And so ever since I started doing this, years prior to and through COVID, $2,155 a month, no change all the way through. So, and kind of like real estate, ATMs are all about location. It's about in the place where you have the right traffic of the type of people that use ATMs a lot. So guess what you can do with an ATM if it's not performing? You pick it up and you move it to another place, right? Same thing, with a rental property. Hey, this thing it's not doing what it's supposed to do. I could raise the rents, I could lower the rents, I could improve the property, change my marketing, offer incentives. When you put your money in the stock market, you have no control whatsoever. All the control is in in the executive team. And it's the same thing when you do it with like a syndication. You're putting so you don't have any control there, but at least the people that have the control.
Ooh, okay. Big subject. Jeepers, this is interesting. Let's talk about you again, the current you. You've created a conventional wisdom quiz. What's that about?
Yeah, so if you go to the website, it's theprolificinvestor.net. It's just a little test where you can there's 10 questions, and they're kind of trick questions because most people think they know what the answer is, and they would be wrong because they're kind of stuck in the conventional wisdom. So if you take the quiz and submit it, you'll get an email back, and it'll tell you what if you answered it right, great. If you answered it wrong, it'll tell you didn't, and it'll tell you why. I think I give you the explanation either way. Why the answer is the way it is. Some of the questions are, hey, it's a great idea to pay off your home. Another question is, there's nothing certain in life instead of death except death and taxes. And some of these are true, false. And the best way to plan for your retirement is, through one of these 401k type plans. And so, a lot of people think, oh yeah, of course it's good to own your house. Of course, that's the best way to do your retirement. But I'll tell people why it's not. and link them to an article that I've written, which has a lot of that math that you love about why it's not.
Okay, so now that I've talked to you and I do know a few of the correct answers.
I know, I'm giving it away.
Well, no, all I'm thinking is that I'm now going to go to Gmail and open up, mysteryinvestor@gmail.com, because I don't want you to know that it's actually me that's taking the test. Ah, dear.
No judgment. I was a conventional investment. I would have gotten all of these wrong at one point in my life, so it's no big deal.
Okay, we've mentioned your book. You have a blog, a YouTube channel. Okay, tell us about the book, about the blog. Just blow your own horn here.
Yeah, so if you go to the prolificinvestor.net, everything is there. There's a place where you could buy the book. You can schedule a free 30-minute virtual coffee with me if you want. We get on a call like this and talk about alternative investments. All the social media icons are there. But yeah, just go to the homepage and click on the coffee cup, I guess, and schedule a free 30-minute call with me, and we'll talk about whatever you want to talk about.
Okay. And just to clarify, that's prolificinvestor.net.
.net, yes.
Okay.
Yes. And of course, the book is Get Off Your $$, and Manage Your Money, Why You Need Alternative Investments. There's a link right there. You can't miss it right there on the homepage. It's got a flashing thing on there. So, yeah. Cool.
Before we wrap today, can I ask you a question that's part of a conversation I had with my son just yesterday? Mm-hmm. And again, a reminder to our listeners, I'm putting Chris on the spot for a personal opinion, not a recommendation. Cryptocurrency. Mm-hmm. It's taken a bit of a beating lately. Is it time to buy or time to bail or time to sit on our hands?
So my personal opinion is I'm very bullish on Bitcoin. So I think it's going to be around for a long time, and I think it's going to be part of the future. And so I'm very bullish on that, and I buy it every Monday, and I'll be doubling up on my buying in Mondays with the current price. So yeah, I think it's going to be around. And there's a really good book that you could have your son read called Layered Money. And I don't know the author. I can't remember the author's name, but it's easy to find. And he goes through, the history of money from seashells to, precious metals, and he uses kind of a layered money theory. So that's a real good and pretty easy to understand and pretty short book. But yeah, I'm buying. Yeah, I'm very bullish. So and people have compared this to, the .com boom, when everything was the internet, pets.com, and everything had a .com or .net. And those companies did the same thing that Bitcoin is doing right now. And this will all sort itself out. Now, there's a lot of people that are going to lose a lot of money and have lost a lot of money in all these other altcoins. And I'm just not doing that, because that's more like, being in the stock. That's really speculating, and it's just not what I do. But I just believe in the long-term viability of Bitcoin, and it will come back. And now, for me personally, is a great time to buy stuff on sale.
Yeah, and he's involved in that world, and he felt the same way. So that's great. Dear. Okay. Anything else before we wrap?
I think I've said just about everything I can say.
And I've picked your brains with all those little mystery questions that I personally want answered. I don't know about the listeners. But listeners, some great ideas and information today. If you have thoughts on today's show, please talk to us. If you're listening at twoboomerwomen.com, scroll to the bottom of the page and leave comments there. We can be found at Apple, Spotify, iHeartRadio, most places a person would listen to podcasts. Feel free to leave comments there and leave stars and reviews. They help us grow. Before you go, hit the subscribe or follow button, and you'll be notified about future interviews with more of my great guests. And share this episode with a few friends who will be around in retirement and you want to share some financial freedom with. Chris has certainly given us some food for thought today.
And share it with a young person, who's got a long runway ahead of them, and we could get them off of this mediocre highway before they even get started, or get them off before they spend too much time on it, So.
Well, I will actually be pointing my daughter and son-in-law to this, because they're looking at that, $1.2 million investment and sort of plotting how to get it paid down, but maybe that's not their best alternative. So that's great. good. If listeners, if you want to be a guest on the podcast or know someone who would be a great guest, there's an application form at the website. Chris Odegard, thank you so much for being my guest on Two Boomer Women today, and not only explaining alternatives to the conventional, but also some possible directions to an end goal. That was great.
My pleasure, Agnes. Thanks for having me on.
Have a great rest of the week.